When we say angel investing, we mean investing in new companies, not necessarily, I'll show you what the thesis is in a second here, but new companies, while they're still feeling new and feeling a little like they don't know what they're doing before they start growing tremendously. And so to split up the life cycle of a company, there's kind of 4 stages that they go through. And there's no standard that I can point to and tell you, here's what those stages are. Here's 4 stages that I will talk about. And if you talk to any, if you like, we're having coffee with a venture capital investor who focused on growth, well, they would split the growth phase into at least 3 parts, if not 4 parts or 5 parts. And if you talk to me with my hat on as Fledge, as the person who runs an accelerator, yeah, I can split the pre-seed part into 3 or 4 little slices. But at 5,000 foot level, there's four main areas. There's pre-seed, which is when the company has an idea, but doesn't really have any customers yet. So how do you get from idea to the first customer? That's pre-seed. It used to be, when I was younger, when I was doing my software startups in the 90s, I could take an idea and I could go to California and I can get it funded. Like the VCs would do that. They don't do that after the dot-com bubble. A lot of the dot-com companies got funded on an idea. Hey, let's sell pet food online, or let's sell books online. Great, here's some money. Yeah, that doesn't really happen that much anymore. So these days, the entrepreneur has to find a way to get the product into the market without asking anybody besides their friends or family for money, unless they can do a Kickstarter, which is pre-sales basically, unless they can do something like pre-sales and sell the product before it exists to get the money to do it. But investors won't show up until there's customers. So then we get to the seed stage, which is where you guys show up. Now we can bring in the angel money. And this could be, there's just a prototype that some customers are using and saying it's good. This could be that there's customers paying. And this could be, you got a company and it's earning $800,000 a year, but they just don't have any outside money yet. It could be as far as that. It could even be $1 million or $2 million in revenue. But typically, by the time a company gets to be $1 million in revenue, they figured out what their product is and they figured out how to sell it. And their issues are different. The problems in front of them are, how do I grow this company? How do I get some money for some marketing? Because I know if I spend it on marketing, I'll get sales, because I have all these other sales in history to point to. So that'd be the growth phase. And typically, from a lot of companies, we can't invest as angels in the growth phase because they need too much money. So if they have $1 million in revenue, they're probably not raising a few $100,000. They're probably raising a few $1 million. And as I said about half an hour ago, the normal size check that angels write is $25,000. And a company will raise money from a handful of angels. Let's call it 10 on the outside. So 10 angels at $25,000 a piece is only $250,000. Maybe they need 20 investors. 20 investors at $25,000 is $500,000. It starts to become really hard for them to raise $2 or $3 million. It's been done. I've seen it done. I've got entrepreneurs who've done it. I've done it. But it's not. It's pretty rare because it just takes an enormous amount of time and a lot of networking and a lot of conversations to raise millions of dollars from angels. So when they get to the growth phase, now we're talking about investing through funds if we're interested in investing in the growth phase. And then when they get to the exit, there's a period in time when we can't play at all because they're now talking about tens of millions of dollars. But exit is when the company gets acquired or goes public. And then after that, they're no longer a startup. You can buy and sell them like any other company. Okay, so how many companies are there? Like how many choices do we have as angels? And the answer is a lot. There are literally millions and millions and millions of startups per year around the world. And we really don't have any statistics on that. We only really have statistics in the United States that are of any useful, any believable numbers. So how many in the United States? Or sorry, and of these million, before I get to that reveal, how many of those companies are funded? Yeah, it's a rounding error. Almost none of them are funded. Most companies are funded solely outside funded. Most companies are solely funded by the founder, their savings account, in the US, their credit cards, and maybe a little bit of friends and family. But in terms of angel investing and VC investing, it's pretty much all of them are unfunded. All right, so I thought I fixed this. I've been teaching this triangle for a long time, and the statistic that I found over and over again, cited, it's researched by the Kaufman Foundation and the Small Business Administration, was 500,000 US companies get started. And I thought for years and years and years, this was per year. And then on a Planet Money podcast last week or 2 weeks ago, I discovered that that's a per month number. So the actual answer is 6 million startups get started in the US per year. 6.2, 6.4. I'm going to round it down to 6 million because it's a nice round number. So sorry, but I've been wrong for years, and I feel embarrassed about that and excited that it's 6 million. What we do know, and this is definitely not wrong, is we know exactly how many checks the venture capitalists write per year, because there are companies like PitchBook that count those up. They track every single investment. We're a little bit uncertain about how many of those are first-time investments, unless you pay PitchBook a large sum of money. The rest of us don't know exactly how many of those are first-time checks to a company and how many are follow-on checks. But this is accurate within 50. Right? It's pretty close. So call it 4,000 companies got their first check from a venture capital fund in 2016. And it's about the same in 2012, 13, 14, and 15. It was slightly more in 17, 18, 19, and it went up again in 20. I showed you the chart. But it's about 4,000. It wasn't 2,000 to 6. It's 4,000. Maybe it was 4,500 last year. It was a busy year. So that's a really small amount. Those venture capitalists are investing only in the companies they think are going to be huge. That's what they do for a living. They put money at risk in order to have huge returns. And so they expect, what they want is all of them to have exits. But we also track exits in this country really well. And in 2016, only 726 companies had good exits, positive exits. So it's not 10%. 10% would be 411. 20% would be 822. Right? It's in the teens. It's a small percentage. Most of the companies that venture capitalists invest in don't succeed. Most of the companies venture capitalists invest in fail. That's a reality of startup life. In terms of just the companies in the US, in percentage terms, less than 0.1% of US companies get venture capital, and almost none have exits. So 0.01% have the exit that the venture capitalists want them. And so I bring this up in a bunch of my lectures because ultimately what I take away from this is that the VC companies get all the news, but they're not the majority, anywhere near the majority. They're not even 1% of the companies. And of course, the exits get the news, the acquisitions get news, the IPOs get news, right? The ups and downs on Wall Street of these previously startups get news. It's the noise. It's news. It's newsworthy because it's so rare. But on the flip side of that, the way I said this before, the way that angels invest is based on how venture capitalists invest, and venture capitalists are wrong more often than not. So I have a big question in my mind and in my actions about why on earth are we following what the venture capitalists do if they're wrong most of the time, right? Why don't we find a better way to do it? Now, again, when you talk to them, and I have mentors who are venture capitalists, and I learned this from venture capitalists, they use the word unfundable. A few slides ago, if I flip back, I said there are, most of the companies are unfunded, but the VCs have a different way of speaking. They'll say they're unfundable, meaning that you can't put money in them and make money, and that's wrong. And I have a whole long lecture on how you can make money at these, but I'm not going to go into it today. I'm going to tell you what their paradigm is that they're stuck in, which is why they're failing so often. And I call it California VCs because it started there. This is true of all the venture capitalists in the United States, with a few exceptions. And if you're unaware, if you think it's a gigantic field with lots and lots of players, there's only about 400 or 500 funds that are active right now. And even in the dot-com bubble, that number was maybe 700. So it's hundreds of companies that do this, not thousands or tens of thousands. It's a pretty small world. All right, so here's their paradigm. Well, all they'll talk about is number 3, but the reality is they will only invest in businesses that have a $1 billion opportunity in front of them, multi-billion-dollar opportunity in front of them. So think of Uber, right? There's taxis in every city, and therefore, if they took over all the taxis in all the cities, that would be multi-billion-dollar opportunity. WeWork is another one of those. Co-working was new when the investors showed up to that, but they said co-working can work everywhere, and it's a multi-billion-dollar opportunity. And Apple, way back in the day, or Microsoft, more fitting because their mantra and their ethos was a desktop on a computer on every desktop, right? And there's a lot of desktops. So they're looking for big things like that. Second part of the paradigm is that they're looking for a business model that can grow to grab as much of that market share as possible. Ideally, if you, for the strongest California VCs out there, to be the monopolist. And again, think Google or Facebook or Amazon along those lines. They want a company that can not just grow fast, but grow so fast that they take over the whole market. And so in order to do that, your first few years could be enormous growth, 10, 20, 30x. But then at a steady state in the growth phase, you're growing 3 times year over year. Growing faster than that is really, really hard to do. But if you're growing 2 to 3 times every year, you're getting to be 100 times bigger in a decade. And then thirdly, of course, they're going to say they need a great team, which they do. They need a great team that can execute that business model to go grab that opportunity. And then there's 2 things they don't talk about. One is that they run a business. So VCs, unlike angels that invest their own money, VCs are investing other people's money. It's a set known amount of money when the fund gets created. And that fund has to put that money to work, is the way we talk about it. They have to invest the money. So they're going to make 15 to 20 investments in the fund. It doesn't matter how big the fund is. The model, for lots of reasons we're not going to go into tonight, the model is they're going to make 15 to 20 investments. We'll just take 20 as a nice round number, which means that on average, they have to use 1/20th of the fund on each investment, not in one check, over the lifetime of that fund and that potential investee. And so if it's $1 billion fund, and if I get this right, it's $1 billion fund, 1/20th of that is $50 million per company. So you have to imagine, okay, I need to find a company where I can write them the first check of $10 million so that the next time they need money a year later, because they got to grow fast, so they're going to burn through money. Second time they need a check, it'll be $20 million. So now I've put 30 to work. And the third time I'm going to run out. But if it's doing really well, I'm going to somehow stretch it up to be 30 or $40 million in the next check. By then, maybe I have my next fund and I can bring that money in from that fund too. And if it's a bigger fund, if it's a $2 billion fund, which exists now too, that's $100 million in a company. So they can't invest in anything that doesn't need $100 million. And it's not only their money. They're never the only investor in a company, rarely ever the only investor. They're usually investing with other VCs. And so this is how WeWork wound up with billions of dollars in Uber, and others wind up with billions of dollars invested in them because there are billions of dollars in the industry. It has to go put to work. And then lastly, again, they will talk about this, just not explicitly. They'll only invest in something where they think it can be acquired. It used to be 3 to 5 years. When I was younger in the 90s, they would say, well, how are you going to get acquired in 3 to 5 years? Who's going to buy you in 3 to 5 years? Then after the dot-com bubble, it was 5 to 7 years. And now here in the 2020s, it's 7 to 10 years. Or I'd say up to 2020, it was 7 to 10 years. It's probably 10 to 15 years now in reality.
Could you go back to the blue point, the plan to burn 1/20th of the capital?
Yeah.
I wasn't fully following. Could you explain again? So is the point that they have to spend a specific portion amount of the money regardless, and that gets them into trouble? Could you
let's take a contrived example where I can do the numbers in my head really simply. Okay. Let's say they raise $20 million. When they go out to make a $20 million fund, they go and find high net worth individuals and institutions and they collect together commitments for $20 million. So those investors, we call those LPs, limited partners, those LPs have promised to put in a certain amount of money each, and it adds up to $20 million. And their expectation is that within the next 5 years, they're going to get called by the VC for this money, and it will get put to work in startups.
Okay.
And so by the end of 5 years, all $20 million will have been invested. And after 10 years, because it's 7 to 10 years, they'll have that money back plus, at least doubled.
Mm-hmm.
And so in order to do that, they're going to only invest 20 companies. They're only going to make 20 investment. They're going to invest money in 20 companies. It could be multiple rounds per company, but they're going to invest in only 20 companies.
Can I ask a question about this? Because this is a part of what confused me. Like, why would they be limited about this specific number of companies to invest in? Couldn't they say, well, we actually found 25 that look good, so we're going to divide it among them?
The reason why it's 15 to 20 and has been since 1962 is because one more rule that they follow when they make an investment is they take a board seat. And it is not feasible for one partner in one VC firm to sit on more than 9 boards.
I see.
And there's typically in a small fund 2 or 3 partners, and really they can't do a good job if they're sitting on more than 6 boards. And so if it's 3 partners and 6 board seats each, that's 18 board seats.
I see.
And they just,
so why isn't a natural way to expand is just to have more partners and have them sit in more boards?
Because the partners cost a lot of money.
I see.
Because ultimately the partners take a very large salary for doing their job, and they share 20% of the profits amongst the partners. So it is a little like that venture capital I talked about, where the ship is the VC fund. The partners are the captain and crew of the ship, and the LPs are those external investors. And the more crew you have, the more shares you have to share across the crew. And so you want to minimize the crew size.
Yeah. Okay. That makes
just enough to do what you want to do. And the pattern that has been created in the 60s and copied ever since is 15 or 20 investments per fund. And there are a couple hacks around it, but that for a full, I always call them full scale venture capital funds, 100, 200, 300, $500 million. And then a smaller number that are 1 or 2 billion. They all follow that same pattern.
Mm-hmm. Okay, great. Okay, so now I understand better why they have to invest in this this number of companies. And so you said this is something that could you go back to why this causes a problem for them?
It just means that the bigger their fund, the bigger their checks. You would think naturally, okay, well, if your $100 million fund did well, and your next fund is $200 million, I can make twice as many investments, but you can't. Right. You're now doing your 5th fund because you started your VC fund in 1995, and the first one did okay because it hit one of the .com successes. Mm-hmm. And so you got to do fund 2 and 3 and 4 and 5, and fund 5 is $1 billion. You would think, okay, well, I can do 10 times more investing than I did with my $100 million fund. The answer is no. You can do 10 times bigger investments, but you can't make any more than you did before. And I just find that a little ridiculous, just like you are right now. I'm saying, just find another way to do it. Maybe don't take a board seat everywhere, and then you don't have that constraint. So that someone else to take the board seat who isn't a partner. Yeah, Mary?
No, you just clarified. I was going to say, so really the constraint still is just the board seats.
It's the biggest constraint. There are some other things. Just tracking down all the investments is also tricky, but the biggest one I know of is the board seat problem. And so one of my mentors who was sat on the board of my last tech company, he peaked at 11 boards. And he said and he was really good at being a board member. He said that was too many for him. And when at last I talked to him, he was semi-retired. He was only on 6 boards. But most people can't do a good job on 6 boards.
Who pays them? Is it the fund or the company they've invested in?
The money comes from the investors. In public companies, directors on boards are paid for by the company. In private companies, the paperwork says there's a There's a salary involved, but VCs don't take that salary because ultimately it's their money anyway. So they get paid by the investors. And we'll go deeper in that in another time. So there are other models, just to be clear, and this is powered by Fledge and Africa Eats. So I'm going to explain my two models. So what Fledge looks for, we're a business accelerator. We are a VC fund in regulatory terms. We're small. We got a few $1 million. So the way the Fledge looks at this is we look for big opportunities, but we're impact investors. So we look at the opportunity both for financial and impact. And the best way I can describe this is we look for ideas that are at least a country in scale. And sometimes it's smaller countries because we do work overseas. We like sustainable growth. We like growth that doesn't burn out the founders and the teams. And that comes out to be about 50% year over year. And it could be 30, and it could be 70, and it could be doubling. It could be 100%. But typically our companies grow at like 50% year over year. We also like teams. And then we just look, the way that we put our money to work, we do small checks at Fledge. We look for companies, we ask the question, when can this company grow to be $500,000 in annual revenues? Not billions, $500,000, right? There's no extra zeros there. And if they're $1 million a year, that's better, but we don't need them to get that big. And so we're fine if the idea they're working on could be national at scale, but they just don't have the desire to get that big. They just want to be a $500,000 a year company doing what they're doing, and other people will copy them. We're good with that because we like the impact. So we like to invest in something that other people will copy, as long as it doesn't kill our company, it's fine. And then we invest using a revenue-based model where they're sharing 4% of their revenues. So we have to invest in companies whose ultimately their margins are much bigger than 4% so that we can have that money. And then we don't need them to be acquired. So just flip back. VCs need their companies to be acquired or go public in order to get their money back out. We don't. We just need these companies to buy back our shares from us, and they use future revenues to do that. And that works really well. But nonetheless, I created yet another model for Africa. And so the Africa Eats model, again, this is 27 Fledge graduates in Africa. And so what we're looking for there is the same thing, big opportunities. It's actually the same companies. So the top ones are going to be the same. And then the difference is on the bottom that we want companies that need capital. In Fledge, we don't care because we're going to give them $20,000. And if that's all they need, that's great. But Africa Eats needs to put more money to work. And so we need companies that need more money. And that's not a problem because everybody needs more money. And then we want our companies, we're going to help them grow into be new national and regional brands. That's part of why we exist. And then we're not trying to get out of our investments at Africa Eats. We have a very strange model in that case. We took a lesson from Warren Buffett at Berkshire Hathaway. And the way that Berkshire Hathaway invests is that when he likes the company, he buys it and never sells it. And so we're doing basically the same thing at a smaller scale, much smaller scale at Africa Eats. We own minority stakes of these companies, and we want to own minority stakes forever. And we're happy with that. And our investees are happy with that. So it's a very different model. And I'm not trying to sell you on this. I'm trying to show you there's alternatives out there. And so I'll give you a homework assignment. I will not grade these, but you're welcome to send them to me and ask for my feedback. But what's your model? So you probably want to watch next week's lecture on impact investing before you answer all these questions. But what's your model? Go ahead, take a screenshot if you want. What size opportunities are you looking for? Mary comes from it says Slow Money Hawaii on her logo there. Slow Money's not looking for big giant opportunities. They're typically looking for local food solutions. So city size opportunities. What comes next after that? I can go back and say, we like sustainable growth. What else do you like? What else is important to you? Oh, sorry, I put and/or over here. Maybe you're not an impact investor, or maybe you're impact first and not a financial investor and just want to get your money back out. You're of course going to need a great team. That goes without saying. That's a big lesson to be learned. Don't invest in ideas. Don't fall in love with the ideas. You will get burned and you'll lose your money. Invest in great teams that have good ideas. Much better to have a good idea and a great team than a great idea and a bad team. And then I threw in two more on here that are important because we're talking about angel investing here. So you got to invest in things that need angel scale capital. And you can choose whether it's only ever angel scale capital or whether they grow up to need VCs or other forms of capital. And what do they need to do in order for you to get paid back? There's lots of ways to do that. And we'll talk about that in some other week as well. Right? All the alternatives. And again, that was Angel Investing 201. That was the lecture I did with Joe. And we talked about lots of different structures.